So the dependency ratio is going to be much higher. Is that ultimately going to bankrupt the government, you think?
Well, it'll bankrupt the retirement system. It'll bankrupt all these things, all these trends. They basically, if something can't go on forever, it will stop, and it will stop because of why they'll ultimately have to change the kind of system that we're in, and transition into, I think, ultimately private social security, because the government is depending on an increased pool of younger and younger people all the time. And what this Lancet thing is suggesting as well, that pool might not be increasing.
Steve Hanke, professor of applied economics at Johns Hopkins University, returns to the show once more to discuss with us his updated views on inflation, economic growth, and the labor market. In particular, we'll be breaking down Jerome Powell's, Fed Chair Powell's speech this week. He gave a speech at Stanford on Wednesday, and we'll be answering a few viewer questions. So thank you for submitting questions. This episode is sponsored by Kudos, so stay tuned for a word from our sponsor later on as well. Professor Hanke, welcome back to the show. Good to see you as always.
Great to be with you, David.
As usual, we will be discussing not just current macroeconomic data, but also what's been going on in the news and answer some viewer-submitted questions. So thank you again to the viewers who have submitted questions to us. We'll go through as much as we can. And to the new viewers watching this program, Professor Hanke and I will be doing this every 2 weeks or so. So please submit to us some questions for the next appearance, either to my own email or Professor Hanke's email, and I'll put both in the description down below. Professor, let's start with what happened today. So we're speaking on the 3rd of April. Jerome Powell made a speech at Stanford this morning, and I'll just read you a few quotes. He said that we do not expect that it will be appropriate to lower our policy rate until we have greater confidence that inflation is moving sustainably down toward 2%. He said regarding recent data, he said, recent readings on both job gains and inflation have come in higher than expected. The recent data do not, however, materially change the overall picture, which continues to be one of solid growth, a strong but rebalancing labor market, and inflation moving down toward 2% on a sometimes bumpy path. So I'd like you to address all three things. So solid growth, rebalancing labor market, and an inflation that's moving down towards 2%. Do you agree with all three fronts?
All right. Number one, it's very important that people realize that the Fed is what they call data dependent. They're looking at the data that are coming up on the screen today, and they're reacting to that daily data. They're not really paying attention to what they should be paying attention to, and that is what has caused those data that they're looking at today to actually move around, and that's what's occurred to changes in the money supply that happened a year ago, year and a half, 2 years, maybe even 3 years ago. So they get faked out a lot, and that's why we have kind of a roller coaster ride with monetary policy going up and down, up and down. And that's why we have business cycles, and that's why we have inflation that goes up. As the money supply is goosed with a lag of a year or two, maybe a little longer, the inflation will go up and so forth. So that's a main thing that you should take away from what Powell is saying. They're not looking at the right data. They're not looking at what causes things to move around. They're looking at things moving around. That's a pretty good way to summarize it, David. So what he's saying is that the economy right now is moving around pretty well. It looks pretty strong if you look at the data today. And as a result of that, what they've gradually moved into is a deferral of reducing and loosening up monetary policy. It looks like now the market's pricing in a loosening up and lowering of those Fed funds rates into the summer, into June, July.
here's my
And maybe, by the way, they keep echoing that, well, we're going to do 3 rate cuts of 25 basis points each. Well, maybe now the thinking is, well, maybe they'll do 2 and they'll be later.
Well, here's what I'm wondering, Professor. Powell used the words inflation moving down toward 2%, which implies a trajectory, or at least some sort of forecast on his or the other Fed governor's part, that inflation is moving down in the future. If they're expecting inflation to continue to move down in the foreseeable future, why not lower rates now? I mean, why not take action now? I mean, we know there's a lag, right?
Right. So the key thing there is that the phrase that you repeated earlier, he said that inflation's coming down, but on a bumpy path.
Okay.
And right now it's kind of in a bump. They're looking at the current data, and it's kind of stalled out. I mean, if you look at the inflation, let's see here. We've got to go back to September. It was 3.7, then it drops down to 3.2, then 3.1, then it pops up a little bit to 3.4, and then down again to 3.1, and then down right now at 3.2. So it's kind of the inflation pack. It is a little bit ziggy and zaggy, but it's the trend is going down, and the reason John Greenwood and I think they will end up at the target or below. The target is 2% or below for the CPI at the end of this year. We think they'll be there, and the reason for that is the money supply is clearly been going down. So you go way back, we're talking about over a year now. It's been declining.
We're going to continue our discussion on monetary policy and then answer a few viewers' questions in just a bit. But first, a word from our sponsor, Kudos. Do you own more than one credit card? Do you optimize them to earn the maximum rewards, or are you leaving money on the table? You can earn more points, cash back, air travel upgrades, and free 5-star luxury hotels, but you may be missing out if you don't know which credit cards to use. That's where Kudos helps. Kudos is a free browser extension which helps you select the best credit card to use to get you the maximum return whenever you shop online. Just tell Kudos which credit cards you own, like the Chase Sapphire Preferred Card and Amex Gold, for example, and when it comes time to check out online, Kudos will automatically pop up to let you know which one to use. My favorite thing about Kudos is that they double your earnings on over 15,000 sites, which means if you usually earn 3% back on Walmart, for example, you'll now earn a total of 6% in rewards with Kudos. And here's the best part. Kudos is completely free. There are no hidden costs, as Kudos simply earns a commission if you shop at a partnered merchant. And as a special offer for my viewers, Kudos is giving the first 100 people who use my code $20 back after your first eligible purchase. That's basically free money. Just click the link below and use the code DavidLin to get Kudos for free today. Join the 150,000 members using Kudos to earn over $100 million in credit card rewards. Get Kudos for free today by clicking on the link below, use the code DavidLin, and start maximizing your credit card rewards. Well, certainly, you forecast, we talked about your forecast before. So according to the quantity theory of money and your work done with John Greenwood, inflation should come down much lower later on in the year. I don't know if the Fed has done similar work. Certainly, they're looking at present data, which suggests that inflation is sort of stalling. The Wall Street Journal is reporting that inflation in the U.S. and in Europe stopped falling and edged higher in certain cases. Even Fed Governor Christopher Waller has said that there is no rush, he used the words no rush, to lower rates. The broader question is, Professor, do you think central banks around the world will forego rate cuts altogether this year?
No, I think they will pivot and start lowering rates, because what's going to happen is that the inflation will start moving down again. It's temporarily kind of stalled out, but given the past monetary contractions that we've had that have been significant, I mean, you're talking, you go back to March of last year, and the money supply is actually contracted by 4.5% in total. And we haven't seen a contraction like that since 1929, 1933. And we've only seen four since the Fed was set up in 1913. Now, all of those four episodes where you had contractions in the money supply resulted in actually recessions, or in the case of the 29-33 contraction, it was very severe. We had a Great Depression, and inflation comes down in those recessions. So that's why not only Greenwood and I think we will have a continued downward trajectory on inflation. That's baked in the cake. And we also think that we'll have an economic slowdown and recession late this year. So that's where we analyze the thing using the quantity theory of money. The Fed is not analyzing things using the quantity theory of money. They're not even paying attention to the quantity theory. They've said over and over and over again that there's no reliable linkage between the quantity of money being produced and economic activity and inflation. So I think they're just wrong on this. I mean, the fuel for the economy is money, and they're not looking at it. They're looking, by the way, and paying attention to interest rates and what they call credit market conditions, monetary conditions in the market. And again, that's a data dependent thing. They're watching what's going on with the interest rates in the market today, and determining whether they're being loose or whether they're being tight, given what's going on with the interest rates in the market. Now, yesterday the interest rates went up a little bit on the second, and the Fed's interpretation of that would be that, well, the market's tightening up. No, my view is no. You look at the money supply to figure out where the tenor of monetary policy is, not the interest rates. Monetary policy is all about the money supply. It's not about interest rates.
Speaking of money and the money supply, here's a question about money velocity, which is defined as the ratio of quarterly nominal GDP to the average quarterly M2 money stock. Now, here's a question from Oswaldo Carciente. It's a rather long, so I'll just pick out the key parts here. He says, since velocity plays a role of equalizer, the notion of monetary lag is blurred. It is even more confusing as most economists postulate that velocity of money tends to be relatively constant in time. By the way, I don't hear you comment much, if at all, about velocity. In any event, which are the factors that may point out to a change in the velocity of money? And I'm going to add to his question, Professor, my own question on top of that. The money velocity, as defined by GDP over M2, has been rising constantly since 2021. Why hasn't that caused, or don't you think that's going to cause further inflation, because the velocity of money is still on its upward trajectory?
Well, no, I don't. Here again, this is a topic. The amateurs get their little feet tangled up on the velocity and get confused a great deal. Greenwood and I have actually looked at velocity in a number of countries since 1960. And if you look at the 24 developed countries that we looked at, the main ones, the velocity of money, again, GDP over M2, is at 1.74% for those 24 countries. So, and it's a little higher for the 64 emerging markets, the countries that we looked at. It's about minus, the velocity is going down minus 3% per annum. Again, the developed countries, it goes down about 1.75% per year negative, and about 3% per year for the emerging market countries. Now, what does that mean? Now, one, it goes down on a trend. and there are deviations from that trend. If you look at the quarterly data, it wiggles around and wiggles around, but it reverts back to the trend, and that's what's been happening right now. We've reverted. You said, well, it's going up. Yeah, it is, but it is reverting back to the trend line, and the trend line in the United States does go down. By the way, almost exactly at that average rate of minus 1.75%. Just as a rough rule of thumb, you can say it's about -2 in the United States. So it does go down on a trend, and there are deviations from it, and the deviations always end up reverting back to the trend. The trend and the actual quarterly numbers come together. That's what reverting back means, and that's basically where we're at right now. So if you the easiest way to think about the velocity really isn't to think about it in terms of GDP over M2, which is the definition of velocity, but to invert that and divide GDP into M2, and what you get then is the cash balance, the desired cash balance, and that goes up, you see, for the developed countries about 1.75% per year, and it goes up about 3% a year in developing countries. Now you say, well, why are they different? And again, the intuition is pretty clear. The cash balances people want in developing countries are rising at a faster rate because the economies are becoming what they call more financialized, more banking, more stock market activity, more money market activity. The financial sector, in short, is growing and expanding at a more rapid rate than it is in a developed, more mature country. So the velocity story, of course, the critics of the quantity theory of money, they put their finger on always velocity, because M equals the money supply, times V, the velocity, equals P, the price level, times Y, the rate of growth, real rate of growth in the economy. And they say, well, velocity is very unstable. So if velocity is very unstable, Hanke, you and Greenwood can't predict what's going to happen to nominal GDP, which is what? It's the price level plus the real rate of growth in the economy. So they poo-poo it because they claim, they assert that velocity is very unstable. Well, it turns out velocity is not unstable. It's very stable.
A lot of us.
And by the way, just to jump ahead.
Yeah.
I've talked about this before, but I looked at a number of countries and published an article called Monetary Facts and Inflation in the International Journal of Economics, and that was last September. I looked at 147 countries, and I looked at the change in the money supply and the change in inflation, and the correlation was almost perfect. It was about 0.94. So if velocity was going all over the place and negating the quantity theory of money, the MV equals PY, you would never get that kind of correlation. This suggested, the big study that I did suggested you had very stable. The implication is that the velocity must be stable. It must not be jumping around, because if it was jumping all over the place, you'd never get a correlation that was almost 1-to-1.
Yeah, I think many of us who studied economics in school, Econ 101 taught us in very basic layman terms that the money velocity roughly equals the economic activity of a particular jurisdiction. So higher the velocity, the more times the money is being circulated, more bustling the economy. A very simplistic definition. And so I think it's understandable that people will look at an increasing money velocity and say, well, clearly there's, higher volume of transactions being made in the economy. Clearly there's a higher propensity to spend in our economy. Therefore, we will have higher inflation. Can you evaluate that logic?
What you're saying is that actually, with the velocity going down, it does what? It implies actually that you have to be increasing the amount of money in the economy to keep it going and at the same rate. And that's why, if you look at the quantity theory of money, and if technically you do the following things, you take MV equals PY, that's the identity, that's the equation of exchange. And if you take that and transform it into logarithms and then differentiate it with relative to time, you end up with M plus V equals P plus Y. And that's easier to deal with. M plus V equals P plus Y. And then if we want to solve for M, the golden growth rate, Hanke's golden growth rate, how fast should the money supply be growing to keep the price level at a constant rate, P at the target, P at the target? You end up with the following thing in the United States. M equals P is 2%. So you plug in 2%. That's the target.
Okay.
So the money supply has to grow by 2% to satisfy the 2% inflation target. Then we have to add something to it. We have to add Y is also something you have to add, and that's about 2%.
Okay.
And then the velocity. Remember, I said that's going down at 2%, but you take that from the left-hand side of the equation and put it on the right with M equals P plus Y minus what? Minus a minus is a plus, and that's a plus V equals what? 2. So 2 plus 2 plus 2 equals what? 6. That's the rate of growth you want to be increasing the money supply at, roughly, in the United States, if you want to hit the inflation target. Right now, the money supply, this is back to our earlier conversation about inflation, David. It's contracting at 2%. It's not growing at 6%. It's contracting at 2%. So that's that right now, looking at just what's happening in February, we've got this continued contraction of the money supply, and we're coming in with a money supply contracting actually at a rate that's 8 percentage points off the golden growth rate of 6% plus.
Okay, we have to move on to another viewer question. This one's pretty good. Has Professor Hanke calculated a range he believes the 10-year Treasury will trade between with high confidence over the next 2 years? For example, I have heard estimates as low as 2% and as high as 6% over the next 2 years, which in my opinion is an extremely wide range.
Okay, that follows onto the conversation we've just had, and I could tell your eyes were kind of glazing over in that last explanation. I think we had too many numbers in that. All you have to remember is back to the last thing with the quantity theory of money equation of exchange, MV equals PY and velocity. The key thing is that the velocity is pretty constant. And that's why when I looked at 147 countries, I had almost a perfect correlation between changes in the money supply and changes in inflation. So that's the end of the story, just to keep it simple. The changes in the money supply cause changes in inflation, and they cause changes in economic activity. So now we're at the 10-year, and we Greenwood and I think, given the quantity theory of money, that what's going to happen is inflation is going to keep coming down, and it'll go down by the end of the year to 2% or below. Now, what that means in terms of the viewer's question about the 10-year is that the 10-year yield is going to go down because yields on long bonds follow changes in the inflation rate. So if the inflation rate's going down from where it is right now, we're talking about the following. We've got the inflation rate of 3.2%, and we've got the 10-year bond up at it's a little over 4.3. So the yield on the 10-year is going to go down as inflation goes down. And that's a good trade, by the way, to be on the long side of a trade, not necessarily an investment, but a trade, because as the yield goes down following the inflation that's going down, we will have a price increase in the 10-year and a capital gain. So you'll make good money on that. You'll make a capital gain if you want to hold that for a trade, a short-term trade. I think it'll be a good, pretty safe bet.
Let's move on to some fiscal issues. We haven't talked much about fiscal policies, you and I, recently. So, first question I have for you: interest payments, as you know, have been going up. Federal government expenditures on interest payments alone currently exceeded $1 trillion. Yes, $1 trillion recently. This is a significant portion of government revenues, as you know. How is the government paying for this? We're going to pay for this if this is projected. I mean, debt is projected to increase, right? And interest rates aren't going down anytime soon. And so it's reasonable to assume interest payments will continue to balloon. How is the government going to pay for this?
Well, they'll pay for the way they pay for everything, with taxes. And there are two kinds of taxes. One is the kind in the United States on April 15th. Of course, you make your quarterly estimates in the United States, but April 15th is a tax day this month. So we're moving in on it, and you pay your taxes. So that's one form of finance. The other is the inflation tax. There are two kinds of taxes. There's an inflation tax and a normal tax. So that's ultimately how they're going to pay. Now, you can defer and move those taxes around a little bit because of borrowing, but ultimately, taxes are how you finance government spending. And they either take it out of your pocket directly, or they take it out indirectly through an inflation tax. One of the two.
Do you think the government will resort to confiscating assets by any means to fund their liabilities or debt or deficits?
Well, now, what do you mean by confiscating assets? Because they do in short confiscate your assets when they make you pay taxes.
Oh, okay. That's an indirect. Well, I don't know. Seizures of property, financial assets, any of that sort. Is there any sort of precedent of this happening in the U.S.? And I think I asked this because there's been some concern.
There was with Franklin Roosevelt during the Great Depression because gold was confiscated.
But that wasn't because they had to pay back their debt, right?
Well, it wasn't that they paid back their debt, but it was a means to finance the government.
Okay.
During the Depression.
Okay.
But so there was actually a confiscation once in the United States that through a mumbo jumbo various legal stretches, in my view, it was deemed to be illegal, not illegal. But normally the government in the United States is pretty constrained in terms of just are they going to come and take my house away? Well, not now. They would if I didn't pay my property taxes. If you don't pay your taxes, they can come after your property. But I think you're thinking of some new tax like a wealth tax or something like that.
Yeah, could that happen?
I well, yeah, they have wealth taxes in Europe. They're 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 basically they've turned out to be a disaster, but they do have them. So the tax base, what you're talking about, I think here is again, it's all about taxes. Governments finance government spending by taxes, various kinds of taxes. And the two general ones I've given you already is cash out of your pocket or indirectly, more indirectly, an inflation tax.
Ultimately,
Now,
why does the average American need to concern himself with the debt to GDP ratio? In other words, can we
oh,
feel the repercussions of that?
oh yeah, because yeah, the debt will, if that debt, if we continue to have deficits and they aren't financed with inflation and they aren't with current taxes, they 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 have to issue bonds, and they're issuing bonds at a very rapid rate, and eventually those get paid by somebody. So what the problem is, you're just deferring payment on the deficiency and government deficit that arises today, and they'll come after you later. You'll have people later will have to pay. You ultimately have to pay. If government expenditures are today and there's a deficit today, that deficit will ultimately be paid tomorrow by somebody. So that's why people should worry about it, especially older people. I mean, older people in retirement are going to be are going to have to pay for the debt that's being racked up today.
Speaking of older people, here's a report. I'd like to talk about demographics now, a longer term theme. Here's a report that was released or covered by CNBC last week. By 2050, the report says 3/4 of countries are forecast to fall below the population replacement birth rate of 2.1 babies per female. By 2100, just 6 countries are expected to have population replacing birth rates. This was published by the Lancet Medical Journal. So,
Right.
what do you make of this trend? What's
Yeah.
gonna? Are we gonna? Are we? Is it just long-term
Well,
economic stagnation?
no. What's it have to do with stagnation? All the countries where you have high birth rates and a high replacement are very poor countries in Africa. So they fan the flames. This is all what would be so bad about having smaller populations? This is all about what they're trying to throw everybody into a frenzy about the fact that the populations are going to be increasing in most countries, if you believe the forecast that they're coming up with the exception of a few in Africa. That's where you've got the
Right.
the
So
high
it's
birth rate.
49 countries, primarily low-income regions, will be responsible for the majority of new births, primarily in sub-Saharan Africa and Asia. You're right. So I mean, most of the new births in the future will come from developing regions and not from.
Right. So let's talk a little bit about the implications. The implication is, and the scare that was put out with this all this talk about low replacement rates and falling populations and everything, that somehow economic life is going to become worse. The only way to become better is to have more people. That's kind of the theme. And the reason for this politically comes back to this thing we were talking about with how do you finance a debt, deficits, how do you finance Social Security? Well, the Social Security systems that have been set up since, particularly since World War II, all over the world, are pay-as-you-go systems. So the retired people, when people retire, who actually pays for the cash that they receive? Well, it isn't the income being generated by the Social Security investments. those are too small. And in fact, most of the systems, the public systems, are basically insolvent. And what makes them solvent, and what allows for the positive cash flow going out of those things? It's young people working. So that's why the population thing comes in, and all the scare stories get fanned with this population issue and demographic issue. It's because the structure of government finance is totally screwed up. It's dependent on having increasing labor pools of young people that are going to be contributing to the Social Security government systems that end up paying the benefits to beneficiaries, the retired people who by the way, are causing a problem because the old people are living longer all the time. So you get the picture of what's going on. We got too many old people, not enough young people. That's
the retirement age may need to be raised, right? No.
Well, I mean, one way to make the pay-as-you-go government system solvent is to just make the retirement age longer and longer.
Yeah, that is one issue, because as health and technology progresses, I think that general longevity of the population in developed countries will increase, and so we have a whole pool of people that are going to be working. So the dependency ratio is going to be much higher. Is that ultimately going to bankrupt the government, you think?
Well, it'll bankrupt the retirement system. It'll bankrupt all these things, all these trends. They basically, if something can't go on forever, it will stop, and it will stop because of why they'll ultimately have to change the kind of system that we're in, and transition into, I think, ultimately private Social Security of one form or another, where people do what they used to do in the old days. You work, you earned income, and you saved part of it, you invested part of it. For what? Your nest egg, your retirement. You didn't depend on the government, because the government basically is turning out to be very unreliable, because the government is depending on an increased pool of younger and younger people all the time. And what this Lancet thing is suggesting as well, that pool might not be increasing. and you might have a problem, because the shrinking younger pool will have to pay more and more and more taxes for Social Security contributions, and that's a loser. You can't, you can only squeeze a lemon so hard, and pretty soon you run out of juice, David.
Okay. I want to go back to the fertility rate thing one more time. Elon Musk tweeted this, and please just evaluate this statement broadly. He tweeted this last January. Population collapse is a major risk to the future of civilization. And all he did was link or post a link to a World Bank fertility rate chart, which is more or less what we just discussed. If you look at this chart, Professor, it shows a long-term trend of fertility rates around the world on an aggregate declining from near 5.5% to now currently only at 2.3%. And of course, it's projected to continue going down. Is humanity basically headed towards, I don't want to use the word extinction, but, much lower population?
Is that he's used the World Bank data. He could have used even more sophisticated, this new Lancet work that is more detailed, but the story is the same. And the reason the disaster has nothing to do with wealth, happiness, and so forth. It's these government retirement systems. They are all dependent on an increasing population of younger cohorts that are working, that can be taxed to finance the systems that are structured by the government and mandated by the government that pay older people in their retirement. That's the that. So again, it can't continue forever. Now, what 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 people like Musk are advocating is that we should increase our fertility. We should have more children. He basically wants to save the systems by having more young people. And I'm saying, well, why not just change the system?
Right.
And by the way, for people like environmentalists, why would environmentalists want more people?
Well,
why wouldn't you want fewer?
is there
Lower
hold on? Is there a correlation between population growth and standard of living? Has that ever been observed? I mean, I'm just look like yeah.
The standard of living most places has gone up as populations have gone up. So this old Malthusian line that you will the populations essentially will bury you and you'll be at a subsistence level. That doesn't work. As populations have gone up, actually, the standard of living has gone up in most places, and the rate of growth in the populations has gone down.
Okay, let's move to two more questions. So this one came from Bruce Posh. 20 years ago, you explained the consequences of FDR forcing China from the silver standard. It was a great history lesson that a younger audience should hear once again. Would you consider the BRICS part of China's 90-year revenge for that? The BRICS being an iceberg and the U.S. being a Titanic. Also included in the iceberg analogy is the huge amount of gold being purchased by China from the West. Is China's revenge eventually going to force U.S. austerity? And wouldn't it be ironic if China forced America to use a quasi-BRICS gold standard one day? More of a musing than a question, but please comment.
Well, I mean, basically what you've had in particular since the war broke out between Russia and Ukraine, and is that BRICS is, and I should add, a lot of sanctioning by the United States and the West on anything or anybody, any country they don't like what they're doing, or any individual they don't like what they're doing. The U.S. imposes financial sanctions on them. So, in a way, that's a weapon of war. So you've had led by the U.S. and its allies, you've had lots of sanctions, and as a result of that, you have a lot of resentment by various countries, including China, including members of the BRICS, and that BRICS group is growing, and it's basically turned into kind of an anti-U.S. allies bloc. So that thanks to the stupidity of sanctions that the U.S. and its allies have put on a lot of these countries and so forth, which, by the way, sanctions never work, and they always have huge negative unintended consequences. I would argue that the sanctions are the reason that BRICS is being strengthened, and basically it's turned the whole thing around. We've just gathered a lot of enemies. Sanctions are one of the negative consequences of sanctions is to gather a lot of enemies, and a lot of people resent you and don't like you. Now, as a free trader, I don't like that. I think peace and commerce is the best way to proceed. You don't want enemies. You want people you can do business with. And we're not going in that direction, by the way. Talking about commerce, protectionism is coming. So that's another blowback. You get this tick for tat thing. You get the sanctions and protectionism being put on by the West, and what happens? Well, you get a reaction by somebody in China like Huawei. Their profits have soared, and Apple's taken the brunt of the cost associated with that. So sanctions on China have done what? They've helped Huawei and they've hurt Apple. Well, Apple's based in the United States. So you're basically shooting yourself in the foot.
By the way, what do you
by
think of
imposing.
the ban on TikTok? So you may be aware of this developing story. The House voted with overwhelming majority to ban "quote unquote" TikTok back in March, a couple weeks ago. TikTok is a Chinese-owned social media company, but it's the fifth largest globally right now by users, I believe. And the ban goes like this: if it passes, if the Senate passes this and Biden approves of this, then the bill goes into effect, and TikTok will have 6 months to sell its assets, its U.S. assets, to a U.S. company. Basically, the U.S. portion will have to be owned by a U.S. company, or the U.S. will ban access to TikTok by Americans on American soil. What do you make of this? Yeah.
Okay, this goes back. This is actually interesting. It goes back to your first question about confiscation of property.
Okay.
That's what the U.S. government, the politicians, are trying to do. So that's my first point. My second point is, you said, well, what do I think about TikTok? I think everybody using TikTok that's of voting age should be voting against any politician who votes in favor of this confiscation and ban on TikTok. That's how you can settle this thing in a hurry. So they have millions of these young people. They are of voting age, and they should be paying attention to how the congressional representatives and senators, as well as the administration, are voting on this TikTok thing. That would be my advice.
Well, the argument from the Congress is that
I take it with that, David. You get the implication of where I am on TikTok.
the argument from Congress is that TikTok represents a national security risk because the data is supposedly, it's stored somewhere where the Chinese government can access, and so
Yeah,
private.
it's stored in the United States by a U.S. company.
Right. Okay. So you don't buy that argument. Well, why do you think they're doing it? Is there an actual national security risk?
This is it. This gets into the whole national security thing, and once you get the leathernecks and boneheads in the Defense Department involved in something, or the CIA, you have problems. The national security thing. So they put the national security blanket around something. But what is it really about? It's really about our commercial war we're at with China.
Right.
People don't realize, the general public doesn't understand what's going on. The U.S. is engaged in a commercial war with China. It's all about China and the commercial war the U.S. is engaged with China. Now they wrap national security wrapper around TikTok, of all things, and make a big deal out of it. But that's what's going on. So any time you get the American flag wrapped around something like TikTok, you better be skeptical about what really is going on. And what really is going on is a commercial war and protectionism being imposed, and it's being imposed against China. China is the enemy.
Right. Okay.
At least I don't think China's the enemy.
I understand. I understand.
You asked me what the political rationale was behind it. They're hiding behind national security.
Let me ask you this: what do you think the Chinese will do in retaliation? I mean, no one knows, but we can speculate.
They'll do something, and it'll hurt the United States, and it'll probably hurt China too.
Okay. All right.
Well, look at the sanctions on. All you have to do is look at Huawei.
Yes.
Look at that. You even had the daughter of the leader of Huawei. She was in jail up there in Vancouver, where you're sitting right now.
That's right. Yeah.
She was cooling her heels in jail. They finally broke her out of jail, and she got her back to China. But the bottom line on that is what? The U.S. imposed a bunch of sanctions on a Chinese company the Chinese company figured out a way to get around that, and their profits they're doing very well, by the way. And there was collateral damage associated with that. The collateral damage hurt who? It hurt an American company called Apple.
True. Okay, final. We'll talk more about this. This is a very interesting topic. We'll talk more about this next time. But the final question from our producer.
Professor, you've advised President Javier Milei, who's currently the president of Argentina, on his economic policy. And when you advised him to dollarize the Argentinian economy, that is to go on the US dollar. Why didn't you advise something like a currency board in which Argentina could have kept the peso but tied it to the US dollar at a fixed exchange rate?
The main reason for that is because in Argentina, they practice what they call anomie. They don't follow the law. If they have a law or a rule, they just ignore it. And we saw that, by the way, in 1991 when they put in the convertibility system, which I had something to do with, and that had many characteristics like a currency board. It linked the peso to the dollar one to one, and supposedly backed it fully with U.S. dollar reserves. So the peso was supposed to be a clone of the U.S. dollar. Well, it turns out there were loopholes in that convertibility law, but they didn't even follow the law itself. And eventually the thing collapsed in 2001. It did a good job for a whole decade, but eventually it collapsed. Why did it collapse? Among other things, it collapsed because the Argentines couldn't even follow their own rules, even though the rules had a lot of loopholes in them, which I disagreed with, but they didn't follow the rules. So if you have a monetary institution and you even had a currency board law that was perfect, like the one I designed and put in Bulgaria, for example, in 1997, my guess is that the Argentines wouldn't follow the law. And in that case, what you want to do is just replace the peso completely with the US dollar. Don't try to do a clone of the US dollar with a currency board, because eventually they'll probably break the rules. You just get rid of the peso and get rid of the central bank. You've got to get rid of the central bank, because if you don't, that central bank will be sitting on the table like a bottle of whiskey next to a recovering alcoholic, and the Argentines will grab for the thing.
Perfect. That's all the time we have today. Well, it was quite a long discussion. So thank you once again, Professor Hanke. Where can we follow your work? Where can we go to learn more from you for the viewers who aren't already following you?
I think, David, the easiest thing is follow me on Twitter. It's just at Hanke. Excuse me. Let's start that over again.
Okay.
Steve _Hanke.
Let me.
And you'll get me on Twitter, and things are going well there. I'm just double checking.
Yeah, 724,000 followers. Very good.
Yeah, 724.6 as we speak on the 3rd of April.
Mm-hmm.
So that's the third most influential economist on Twitter right now in the world.
Congratulations.
So that's one place. Also, you can just send me an email, hanke@jhu.edu, and say you want to be on my distribution list. I'll put you on the list.
Yes, please do. Okay, we'll put both in the link down. We'll put both in the description down below. Thank you very much, Professor. And we'll speak to you in a couple of weeks. Take care.
Okay, keep those questions coming from the viewers.
Yes, please do submit questions once again. I'll remind the viewers, they've been very helpful, and it's great for engagement. So thank you once again. See you soon.